When people think about trading, they often picture this really frantic, complex world, right?
Yeah, definitely. Lots of screens, flashing lights, maybe some secret software.
Exactly. Secret indicators, cutting-edge tech. But what if the real secret to making consistent profits was actually simpler, like stripping all that away?
What if less is more?
Precisely.
Mm.
Today, we're doing a deep dive into naked trading in the Forex market.
Ah, good topic.
Yeah, we're leaning heavily on the insights from Naked Forex, High Probability Techniques for Trading Without Indicators by Alex Neckritton and Walter Peters.
Great book. Really practical stuff in there.
It is. And our mission today is really to unpack why some expert traders believe less is actually more, why they focus on, the raw, unfiltered truth of price action.
Getting back to basics, essentially.
Right, and exploring how you, the listener, can maybe develop the mindset and skills to trade without all that indicator clutter.
Sounds good. Where should we start?
Well, let's start with the basics. Forex itself. Many know it's huge, but the book lays out some fundamentals about its scale and, maybe more surprisingly, how the retail side works. Can you walk us through that a bit?
Sure. The scale is, well, it's staggering. The Forex market turns over 5 times the daily amount of the New York Stock Exchange.
Wow. 5 times.
Yeah, it's massive.
Yeah.
But, and this is really crucial, there's a big difference between the real interbank market, where the big banks, hedge funds, governments play.
The institutional level.
Exactly. And the retail Forex market, which is where most individual traders operate. Probably many listening right now.
And this is where the book drops a bit of a bombshell, doesn't it? About how those retail brokers sometimes operate.
It really does. It's quite eye-opening. The book suggests that many retail brokers categorize traders internally. They might put them into winner and loser groups.
Seriously. Winners and losers.
That's the claim. New accounts apparently often start in the loser group, and it might take several months of consistent profit.
Consistent being the key word.
Absolutely. Consistent profitability before they might move you to the winner group, and then the broker might actually start hedging your trades in the real interbank market.
So before that, they might just be taking the other side of your trade internally.
That's the implication for many in the loser group, yes. It certainly paints a picture, and it underlines a pretty sobering statistic the book mentions. Only about 25.2% of retail Forex traders are consistently profitable.
Just over a quarter. That's stark. It really highlights the challenge.
It does.
Does the book get into why that number is so low, beyond just how brokers might operate? What makes it so tough for most individuals?
Yeah, it definitely touches on that. A lot of it comes down to psychology, honestly, and the overall approach people take.
Like chasing systems.
Exactly. Most new traders are on that hunt for the magic indicator, the perfect system, which brings us right to the core idea of naked trading.
Right, because normally traders use fundamental analysis, economic news, or technical analysis, which is heavy on indicators. But this naked approach, it just throws that out.
Pretty much. It goes against the grain. The core belief is simple. Price is the most important indicator. Full stop.
Because everything else is just derived from price anyway, right? Using some formula.
Precisely. All other indicators are just price data run through a mathematical formula.
The book has a great analogy for this, doesn't it? Something about a wristwatch.
It does. It's like using a formula to sort of manipulate the time on your watch to make it tell better time.
Huh. Who wants a watch that doesn't show the real time?
Exactly. And that's kind of what indicators often do to price data. They filter it, smooth it, delay it.
So what are the fundamental problems with relying on those technical indicators, according to the authors?
Well, the biggest one is indicator lag. It's unavoidable.
Because they're calculated from past data.
Right. By definition, they lag behind what the price is doing right now. Think about common examples like RSI signals for overbought or oversold.
Or MACD crosses.
Yeah, those MACD crosses. They often flash a signal after the market has already started to turn around. You're late to the party.
So you miss the optimal entry.
You often do. Naked trading strategies, because they're based purely on current price action, can potentially get you in earlier.
And maybe allow for tighter stop losses.
Potentially, yes. Which can be huge for avoiding those really nasty drawdowns, those big hits to your account.
Okay, lag makes sense. But some people argue indicators provide clarity, maybe objectivity, that raw price action feels subjective.
That's a fair point, and it leads to the second big problem the book highlights. The blame trap.
It's a blame trap.
Yeah. Indicators can easily become a crutch. Or worse, a scapegoat when things go wrong.
It wasn't me. It was the indicator giving a bad signal.
You got it. It's much easier to blame a squiggly line than to look at your own decision-making process.
So without indicators, you're forced to take ownership.
Exactly. Naked traders are much more likely to take full responsibility for their results, wins, and losses. And that, the authors argue, is absolutely crucial for growth, for actually improving as a trader.
Okay, so we ditch the indicators, we avoid the lag, we take responsibility. What do we look at on the chart then? It can't just be random squiggles.
No, definitely not. The focus shifts to key price levels. The book calls them zones.
Zones, like support and resistance.
Similar, but maybe a bit more nuanced, they describe them as market scars.
Market scars, I like that.
Yeah, it's evocative, isn't it? These are specific price levels where the market has, repeatedly reacted in the past, stopped, reversed.
So the market has a memory.
In a way, yes.
Yeah.
The book uses this great little anecdote, the hot pizza story.
Oh, yeah.
The author remembers getting burned by a hot pizza pan as a kid, and now he's naturally wary of hot pans.
Makes sense.
Well, the market is similar. It remembers where it got burnt, where price reversed sharply before, so it tends to react at those levels again.
So finding these zones is the first step.
It's the first step in considering a trade. Price hitting a zone doesn't automatically mean trade now. It just means pay attention. It puts you on alert.
Okay, these zones sound critical. How do we actually find them? Any practical tips from the book?
Yes, definitely. One really effective technique is to move up one time frame.
So if I trade the hourly chart,
Look at the 4-hour chart, or even the daily, to find the really major zones. A few touches, a few reactions on that higher time frame.
will translate to many touches on my lower time frame chart.
Exactly. It filters out the minor, less significant levels, helps you see the bigger picture, the really important battlegrounds.
That's smart. Any other tricks?
Another good one is to temporarily switch to a line chart.
Instead of candlesticks or bars.
Yeah. A line chart just connects the closing prices. It smooths out all the noise, the ups and downs within a single bar or candle. Often, the key zones just pop out much more clearly.
Interesting. Does it matter which closing price?
The book highlights the North American close, around 5 p.m. New York time, as particularly important.
Why that specific time?
Because it captures the overlap and handover between the European and American sessions. A huge amount of volume goes through around then, so that closing price reflects a broad consensus.
Got it. And avoid clutter.
Absolutely. Don't draw lines everywhere. Avoid those minor zones that only show up on very short time frames. Focus on the levels where price has clearly, repeatedly reversed. Those are your high probability areas.
Okay, so we found our zones, our market scars. Price approaches 1. Now what? As you said, it's not an automatic trade. How do we get the actual entry signal?
Right. That's where the catalysts come in. These are specific price action patterns that signal a high probability of a move starting from that zone.
Because the market moves in phases, right? Choppy consolidation, then strong trends.
Exactly. It waffles around in consolidation, trying to figure out where to go next, and then it breaks out into a trend. These catalysts help us spot the potential start of that trend right at a key zone.
Makes sense. Can you give us some examples? What are some key naked trading catalysts?
Sure. Let's unpack a few powerful ones from the book. First up is the last kiss.
The last kiss. Sounds dramatic.
Huh. It kind of is. It's a breakout strategy. First, you identify a clear consolidation zone, basically. Draw a box around a period of sideways, choppy price action.
Okay, cut the box.
Now, most breakouts from these boxes actually fail. Price pokes out, then dives right back in.
A dreaded fake out.
Exactly. But a last kiss happens when price breaks out decisively then. And this is the key part. It pulls back to retouch the edge of that box it just broke out of.
Like a little goodbye kiss to the old range.
Precisely. Before then continuing strongly in the direction of the breakout.
And the signal is that retouch.
The retouch needs to happen with conviction. You want to see a strong candlestick form right at the edge of the box, confirming the breakout direction. A strong bullish candle for an upside break. Strong bearish for a downside break.
That's a clear pattern. What about managing risk on that one? The book had something unique there.
It did. A very clever emergency stop-loss calculation. It's based on the height of the consolidation box itself.
Oh, interesting. How does that work?
You measure the distance between the top resistance and bottom support of the box. Take half that distance. For a long trade, breakout up, you add that half distance to the support level of the box. For a short trade, breakout down, you subtract it from the resistance level.
So tighter the consolidation, the tighter the stop loss.
Exactly. It tailors your risk specifically to the volatility of that consolidation period. Very smart.
Cool. What's another catalyst?
Okay, next is the big shadow. This is a 2-candlestick pattern.
2 candles, right?
And the absolute key here is the closing price of the second candle, the shadow candle.
The close is crucial.
Hugely. For a bullish big shadow, signaling a potential move up, you want that second candle to close very, very near its high. Shows strong buying pressure right into the close.
And bearish, close near the low.
Yep. A close near the low signals strong selling pressure. The book is very clear. Closes near the midpoint of the candle. Those are poor setups, weak signals.
Okay, close is key. Anything else about the big shadow?
Yes, the concept of room to the left.
Room to the left, like empty space on the chart.
Exactly. The best big shadow setups happen where there's very little recent price action immediately to the left of the pattern.
Why is that important?
It suggests that the market is making a significant turn in relatively unexplored territory, like no man's land. There's no immediate nearby congestion or old support resistance to potentially block the move.
So, plein air ahead?
Pretty much. The more room to the left, the higher the probability of the pattern working out, according to the authors.
Fascinating. Got another one for us.
How about whammies and mullahs?
Whammies and mullahs. Okay, you have my attention.
Uh-huh. These are specific types of double bottoms, whammy, and double tops, mullah. They're based on simple market logic.
Like the market trying a level twice.
Exactly, or seeing higher lows suggesting buyers are stepping in earlier. For a whammy, the bullish double bottom pattern, you need 3 things.
Okay.
1, the market tests the support zone twice. 2, crucially, the second low is higher than the first low.
Showing decreased selling pressure or increased buying pressure.
Right. And 3, there needs to be at least 6 candlesticks between those 2 lows.
Why 6?
Fewer than 6 might just be noise or a pause before breaking lower. 6 or more suggests a more deliberate, significant test and rejection of the level.
Makes sense. And a mullah is just the opposite.
Mirror image for a bearish double top. 2 touches of resistance, the second high is lower than the first, and at least 6 candles in between.
Whammy for bottom, mullah for top. Got it. Any more catalysts?
One more key one, the big belt. This one's rarer but significant. It's a single candlestick pattern.
Single candle. Okay.
It often appears right at the start of the trading week, like on a Sunday night or Monday morning.
After the weekend gap, maybe.
Sometimes, yeah. It often represents the market pushing too far in one direction, maybe an overreaction to weekend news or just repositioning. It must print right at a significant support or resistance zone.
And what does it look like?
A bullish big belt opens near the low of the candle and closes very near the high, showing strong buying all session. A bearish one opens near the high and closes near the low. Big, dominant candle.
And does room to the left apply here too?
Yes. Just like the big shadow, the best big belts also have that clear space to the left, indicating a potential turning point in open territory.
Okay, those are some really concrete patterns to look for at key zones. But getting in is only half the battle, right? The book really stresses the exit.
Oh, absolutely. Getting out effectively is where you actually lock in profits. It's arguably the most crucial part.
The authors break down a trade into 6 stages, right? Analysis, planning, entry, management.
Exit and learning.
Yep.
And they hammer home that the exit is where the money's truly made or lost. That's when you get paid or you cut a loss.
And your personal style matters a lot here too, doesn't it? The whole gunner versus runner idea.
Hugely important. You need to know yourself. Are you a gunner? Someone who prefers a higher win rate, taking smaller, quicker profits off the table consistently.
Sniping prop.
Kind of, yeah. Or are you a runner? Someone aiming to catch those massive trends, willing to endure more small losses or break-even trades in pursuit of that home run.
Letting winners run, basically.
Exactly. And the book stresses there's no right or wrong style, but you must know which one you are and stick to it. Your exit strategy has to match your style.
So what are some naked exit strategies the book suggests?
Let's look at 3 powerful ones. First, the zone exit. This is perfect for gunners.
Simple and direct.
The simplest. Your profit target is just the very next significant support or resistance zone. If you buy, you aim for a few pips below the next resistance zone. If you sell, aim for a few pips above the next support zone.
You know exactly where you're getting out before you even get in.
Precisely. Clean, objective, takes the guesswork out.
Okay, what's next?
Second, the split exit. This is also good for gunners, but maybe those who want a little more potential.
How does that work?
You divide your position size, say, into 2 equal halves. You exit the first half at that nearest zone, just like the zone exit, bank some profit.
Secure the bag, partly.
Right. Then, for the second half, you immediately move your stop loss to your entry point break-even.
So the rest of the trade is risk-free.
Exactly. Now, you let that second half run, potentially towards the next zone after that, knowing you can't lose money on it. It's a nice blend of securing profit and letting potential winners run a bit further.
I like that. And the third one, for the runners.
That's the ladder exit. This is designed specifically for catching big trends. It's a type of trailing stop, but based on zones.
Trailing using zones, not just points or percentages.
Correct. As the market moves in your favor and reaches a new significant zone, you move your stop loss up to just behind the previous zone it broke through.
So you're laddering your stop up or down from zone to zone.
You got it. This gives the trade room to breathe, to handle pullbacks between zones, allowing you to stay in potentially huge, long-running trends.
But you might get back some profit from the peak if it reverses between zones.
Yes, that's the trade-off. You won't always exit at the absolute peak, but you maximize your chances of capturing the majority of a major move. It fits the runner mentality.
These exit strategies seem really clear, but sticking to them must be tough sometimes. What's a major pitfall here?
The biggest one the book warns about is retrading the last trade.
Meaning letting the outcome of your last trade influence your decision on this one.
Exactly. If you just had a big win, you might get greedy and ignore your exit rule. If you just had a loss, you might get scared and jump out too early.
Emotional trading.
Totally. The key is discipline. Every trade is independent. Stick to your predefined exit strategy for this trade, no matter what happened last time.
That leads perfectly into the whole psychology aspect. Many traders obsess over finding the perfect system, but the book really shifts the focus, doesn't it?
Massively. It suggests the biggest predictor of success isn't the system. It's you.
The trader themselves.
Yes, it's a huge mental shift for many people.
The authors talk about a cycle of doom. Can you explain that? It sounds ominous.
It is. For many aspiring traders, it goes like this. Step 1 is the search. You're always looking for that exciting new indicator or system that promises riches.
The Holy Grail hunt.
Exactly. Step 2 is action. You find something, get excited, and start trading it live, usually with high hopes, but often without really testing it properly.
Jumping the gun.
Right. Which leads inevitably to step 3, blame. The system doesn't work as expected, you hit a losing streak, you get frustrated, scrap the system.
And go right back to the search phase.
Bingo! Back to square one, looking for the next magic bullet. It's a destructive cycle.
So how do you break it? What's the revelation?
The revelation is simple but profound. Profits come from traders, not from systems.
Wow. Say that again?
Profits come from traders, not systems. The system is just a tool. The key to breaking that cycle is taking full responsibility for your trading results.
Owning it.
Owning it. Then, choosing a methodology, a system you actually understand and believe in, like maybe one of these naked strategies, and then,
Oh, wow.
this is crucial, testing it extensively before you risk real money.
That sounds like work.
It is work, but it's the work that actually leads to results, instead of just chasing rainbows.
Taking responsibility seems hard, though. It requires facing your own mistakes, doesn't it?
It absolutely does. And that's often the hardest part for people admitting they were wrong or that their execution failed, not just the system.
So if profits come from the trader, how do you become one of those expert traders, like the bank guys or the hedge fund managers? What's their secret, according to the book?
You might be surprised. The secret is often simplicity and repetition.
Simplicity, not complexity.
Not usually. Expert traders, the really consistent ones, tend to focus. They often master one market or one core trading system, one specific edge.
And just apply it over and over.
Relentlessly, to the point where, for them, profitable trading actually becomes kind of boring.
Boring. We expect excitement.
Right. But the pros often find their edge and just execute it consistently. The excitement comes from the results, the consistency, not from the moment-to-moment thrills of the market.
Okay, so how do we achieve that? What are the concrete steps to get to that boring but profitable stage?
The book lays out a clear path. Step 1, learn to identify zones. Get really good at spotting those key turning points on any chart, any time frame. That's foundational.
Master the market scars.
Exactly. Step 2, choose your catalyst. Don't try to trade every pattern. Pick one naked setup, last kiss, big shadow, whammy, whatever, that makes sense to you, that resonates with how you see the market.
Become a specialist in one pattern first.
Precisely. Master one thing. And step 3, the most important habit, backtest extensively.
We keeps coming back to backtesting.
Because it's that important. Manual backtesting especially. Going through historical charts candle by candle, making decisions, tracking results.
Why is it so powerful?
Several reasons. One, it proves to you whether your chosen setup actually has an edge. 2, it builds incredible confidence. You've seen it work hundreds of times. 3, it prepares you emotionally for drawdowns because you'll experience them in testing. 4, it's simply the fastest shortcut to gaining experience and expertise.
Faster than just demo trading live.
Much faster, the authors argue, because you can cover months or years of market data in days or weeks. They suggest aiming to, say, triple a demo account using your system with low risk, like 1–2% per trade, purely through backtesting first.
Triple an account just in backtesting. That builds serious confidence.
Immense confidence.
Oh, yeah?
And skill.
So when you're designing your own system based on this, what else needs to be defined besides the catalyst and zones?
You need crystal clear rules. Rules for entry, rules for exit, rules for trade management, and rules for risk. And they need to be, as the book says, just this resistant.
Meaning no exceptions.
No, just this one time I'll bend the rule. Discipline is key. You also need to consider your approach. Are you a market specialist, mastering one currency pair with multiple strategies? Or a trade specialist, mastering one strategy like the last kiss across many different pairs?
Backtesting would help figure that out too, I guess.
Absolutely. And you need to choose a time frame that genuinely fits your life, your schedule, your personality. Shorter time frames demand more screen time, more intensity. Longer time frames might be better if you work full time.
Makes sense. And underlying all of this planning and system design is risk management, right? The book seems to treat it as paramount.
It is paramount. It's not just important, it's the key to survival and long-term success.
So what does good risk management look like in this context?
First, understand your personal risk appetite, or what the book calls your sleeping point.
Sleeping point.
Yeah. How much risk can you take on a trade or across all your trades without it stressing you out, making you lose sleep, or causing you to constantly check your phone? If you're feeling anxious, your risk is too high for you.
It's personal.
Very personal. Second, set a maximum drawdown. Have a hard stop loss for your account, maybe on a weekly or monthly basis. Like, if my account drops 5% this month, I stop trading and reevaluate.
A circuit breaker for your account.
Exactly. And if you find yourself taking multiple trades that are highly correlated, like several trades on different yen pairs at the same time, you need to adjust your position size on each one so your total risk stays within your comfort zone and your drawdown limit.
Don't stack correlated risk unknowingly.
Right. Third is developing trading tolerance. This comes from consistently risking the same small percentage of your account on every single trade. Maybe 1%, maybe 2%.
Why is that consistency so important?
Because it trains your brain to accept the normal financial ups and downs of trading. The wins and losses become routine in monetary terms, allowing you to focus purely on executing your strategy well, rather than getting emotional about the money on each trade.
Detaching from the dollar amount.
Precisely. At the end of the day, the authors state unequivocally, the #1 skill in trading is playing defense, protecting your capital.
It really is striking how much of this comes down to psychology, mindset, habits. Almost more than the chart patterns themselves. Why is understanding, say, your core beliefs about money so vital?
Because those deep-seated beliefs drive your behavior, especially when you're under pressure, when real money is on the line. Your subconscious attitudes about risk, wealth, failure, success, they can sabotage even the best trading system if they aren't aligned with disciplined execution.
So self-awareness is key.
Absolutely. Know your trading personality. Are you naturally a trend follower, someone who likes to go with the flow? Or are you more of a contrarian, looking for reversals, maybe more like a gunner? Trade in a way that feels natural to you. Don't fight your own inclinations.
And it's not just mental, is it? The book mentions physical well-being, too.
Yes, hugely important. Prioritize physical and psychological fitness. Get enough sleep, exercise regularly, limit excessive screen time, maybe practice meditation or just quiet time, and definitely avoid trading under the influence of alcohol or when emotionally compromised.
Treat yourself like a professional athlete treats their body and mind.
That's a great analogy. These habits recharge your psychological batteries, giving you the mental stamina for disciplined trading.
What about when discipline just fails? We all slip up. Any advice for combating indiscipline?
2 key things: accountability and record keeping. Find a trading buddy or mentor you're accountable to. Share your rules and your results. Knowing someone else is watching helps keep you honest.
External pressure.
And internal too. Keep detailed records, not just profits and losses, but why you took a trade, maybe screenshots, journal your thoughts and feelings. Reviewing this helps you see where you deviate from your plan.
Shine a light on the mistakes.
Exactly. And finally, related to beliefs, set realistic expectations. This isn't a get-rich-quick scheme. Consistent profitability comes from disciplined application of an edge over time, not from home runs every day.
Wow. That's a lot to digest. But it paints a very clear picture. It's not about secret indicators. It's about understanding price, mastering a simple edge through practice, and really truly mastering yourself.
That's the essence of it. The market gives you the clues in the price action. Your discipline, your execution, your mindset, that's what turns those clues into potential profits.
So you, the listener, now hold the core principles of naked trading. It's a path that emphasizes clarity over complexity, practice over prediction, and psychology over complicated software. The market provides the map. Your discipline charts the course. Here's a final thought to mull over. What single action, however small, will you take today to start embracing this journey towards clearer charts and maybe, just maybe, a clearer trading mind?